Hello everyone, and this is Sia Jane, and welcome back to my channel ACCA and Beyond. So, I'm going to continue our revision series in which I'm going to revise every ACCA Audit and Assurance chapter with you guys from the Kaplan Study Kit. So, today's chapter is going to be chapter number 4, Ethics and Acceptance. So, let's quickly get started. Now, let's understand the need for professional ethics. uh, Practitioners are expected not only to behave in an ethical manner but also to be seen in ethical eyes in the eyes of to be seen as ethical in the eyes of others. uh, but this means that they take active steps to ensure that every professional decision and action they take is ethically sound. Pro- Professional accountants also have a responsibility to act in the public interest. This is especially important in the assurance engagements, where the main objective is to increase the confidence of the intended users. For this confidence to exist, users must be able to trust the professional providing the assurance. In order to build a trust, the assurance provider must be independent of the client. Independence ensures that the professional judgment is not influenced or biased in any way. Independence can be defined as freedom from situations and relationships where objectivity would be perceived to be impaired by a reasonable and informed third party. In other words, it's not about being independent but also appearing independent. A reasonable and informed third party does not need to be an accountant but should have enough relevant knowledge and experience to understand and evaluate the situation. This person should be able to assess whether the accountant's conclusion are objective and unbiased. Now, the IFAC through the IEASBA has issued a code of ethics, and similarly, ACCA has also issued its own code of ethics and conduct. Although these are issued by different bodies, they are based on the same underlying principles and are, for all particular purposes, identical. Both of these codes follow a conceptual framework. This framework focuses on three key elements. First, it identifies the fundamental principles. Second, of ethical behavior that professionals must follow. Second, it highlights potential threats. And third, it provides possible safeguards that can be applied to eliminate these threats or at least reduce them to an acceptable level. Now, ethical guidance can generally follow two approaches: a principles based approach or a rules based approach. A conceptual framework is based on a principles based approach. So, conceptual framework, principles based. It can be asked as an MCQ. Uh, this means that instead of following strict rules, professionals are required to apply judgment based on ethical principles. Both IESBA and ACCA follow this principles based approach. Finally, if an accountant or auditor identifies a breach of the code of ethics, they must act promptly. They should address the consequences of the breach and also consider whether it needs to be reported to the ACCA or any other relevant professional or regulatory authority. Now, let's understand the difference between a principle based approach and a rules based approach. A principles based approach focuses on following the spirit of the guidance rather than just strict rules. It requires accountants to use professional judgment in different situations. This approach is flexible, which means it can be applied even in new, unusual, or rapidly changing scenarios. It can also be applied across different countries where laws may vary. At the same time, it can include specific rules for common ethical situations that affect many firms. On the other hand, a rules based approach focuses on strict compliance, up, uh, sorry, with clearly it follows a strict compliance with clearly defined rules. This can make it easier to follow since the requirements are very specific. However, it needs frequent updating to remain relevant in new situations. It may also encourage accountants to interpret rules narrowly, just to technically comply even if they go against the spirit of the guidance. And in practice, it is almost impossible to create rules for every possible situation, especially in a dynamic and global environment. Now, in terms of consequences, practitioners are expected to apply the spirit of code in their everyday work. If they fail to comply, professional bodies like ACCA can take disciplinary action. This can include fines, suspension of membership, or even withdrawal of membership. Okay. Now let's look at the fundamental principles. The fundamental principles establish a standard of behavior expected of a professional accountant. So basically, these are the core rules that guide how an accountant should behave in all situations. First, objectivity. A professional accountant must exercise professional or business judgment without being compromised by bias, conflicts of nature, or undue influence. In simple terms, this means your decision should always be unbiased. You shouldn't let personal interest, pressure from others, or any external influence um, affect your judgment. A professional accountant must comply with relevant laws and regulations and avoid any conduct that might discredit the profession. So, here the focus is on following laws and maintaining a good professional image. Your actions should always reflect positively on the profession. Professional competence and due care. A professional accountant must maintain knowledge and skills to ensure competent professional services. This means you need to stay updated and capable. You can't rely on outdated knowledge and you have to continuously improve and perform your work carefully and diligently. A professional accountant must act diligently and in accordance with the applicable technical and professional standards. So, not just knowledge, but also how carefully and properly you apply it in real life matters. Integrity. A professional accountant must be straightforward and honest in all professional and business relationships. This is about being honest and transparent at all times. No misleading information, no manipulation, just fair and truthful conduct. Confident, Confidentiality. A professional accountant must respect the confidentiality of information acquired as a result of professional and business relationships. They should not disclose any such information to third parties without proper and specific authority, unless there is a legal or professional right to disclose. This means you cannot share client information with anyone unless you have permission or there is a legal requirement to do so. Such confidential information should not be used for the personal advantage of members or third parties. And very importantly, you should never use that information for your own benefit or for someone else's benefit. So, overall, confidentiality is about maintaining trust and ensuring that sensitive information is handled responsibly. So, a safeguard is an action or measure that eliminates a threat or reduces it to an acceptable level. Now, so yeah, sorry. So now let's understand self-interest threats. Self-interest threats arise where the auditor has a financial or other interest that may inappropriately influence their judgment or behavior. So basically, if the auditor stands to gain something personally, it can affect how objectively they make decisions. So first we have fee dependency, self-interest and intimidation threats. Both of them are from a fee dependency. Can be created if the total fees generated from one audit client represent a large proportion of the firm's total fee or a significant portion of a partner's revenue. In simple terms, if a firm is earning too much from one client, it becomes dependent on that client. This over dependence can create pressure on the auditor. For example, the auditor may ignore necessary adjustments in the financial statement because they don't want to risk losing that client. So overall self-interest threat arise when personal or financial interests start affecting a professional judgment. Now let's look at the factors relevant when in evaluating this threat. Uh, these include operating structure of the firm, whether the firm is expected to diversify, the significance of the client, and the extent to which partner compensation depends on the fees from the client. Uh, so basically, we are trying to assess how dependent the firm is on that particular client and how much influence that client has on the firm's decisions. For non listed clients, a firm's independence is threatened if total fees from one client exceed 30% of the firm's total fee for 5 consecutive years. So, if one client is contributing too much revenue over a long period, independence becomes a serious concern. In such cases, an engagement quality review must be performed. This review can happen before the audit opinion is issued for the fifth year or after issuance but before the 6 years opinion. And importantly, this review must be done by someone independent, either outside from the firm or by a professional regulatory body. Now, if the fees from one client is come from a large proportion of the firm's total fees, certain safeguards should be applied. These include reducing other services provided to the client, so the firm limits how involved it is with that client, increasing the client base or providing services to other client. This helps reduce dependence on a single client. Having an appropriate reviewer who is not member of the firm review the work. This ensures an independent check on the audit and ensuring that partner compensation is not heavily influenced by fees from that client. So overall, the idea is to reduce dependence and maintains independence by applying suitable safeguards. For a joint audit agreement arrangement, where two or more firms are engaged to conduct the audit, the involvement of the other firm can be considered a safeguard, provided certain conditions are met. So basically, if two firms are involved, it can reduce dependency risk, but only if one firm is not overly dependent and both firms are doing enough work to take responsibility. Now, take a look at listed clients. A firm's independence threatened if total fees from listed clients exceed 15%. So, for non listed clients, it is 30%, and for listed clients, it is 15%. And this is for 2 consecutive years. So, 30% for 5 years, and this is for 2 years. So, compared to non listed clients, our threshold here is stricter. An engagement quality review should be performed by a person not a member of the audit team before the second year's audit opinion is issued. Sorry, not audit team, audit firm. If fees this ensures an independent check early on. If fees continue at this level for 5 consecutive years, the firm must resign as auditor after issuing the fifth year's opinion. So at that point, the risk is considered too high. An exception may be allowed if the professional body believes it is in the public interest, but in that case, a pre assurance review is required for subsequent years. So, only in special cases the firm can continue, but with stricter safeguards. For a joint audit engagement arrangement, the involvement of other firm can act as a safeguard if dependency applies to only one firm and both firms take full responsibility. Again, the idea is to reduce over reliance on one firm. Now about gifts and hospitality. Acceptance of goods and services or hospitality from an audit client can create self interest, intimidation, and familiarity threats. So, even small things can affect independence. Gifts and hospitality should not be accepted unless they are trivial and inconsequential. So only very small, insignificant items are allowed. Even if they are small, if they are intended to influence behavior, they should not be accepted. Um, so intention matters, not just value. For example, if a client offers to take the audit team out for an expensive meal, it creates a self-interest threat. Before accepting, the auditor should consider factor like timing, whether the offer is made before or after the audit report is signed, and whether it could influence their judgment. So, overall, the focus is always on maintaining independence and avoiding any situation that could affect objectivity. Uh, so, The auditor will want to maximize return from the investment and overlook audit adjustments which would affect the value of their investment. When sorry, let me just drink water. So where were we? I think we just started this page. Um, so we were on owning shares and financial interest. So if an auditor owns shares in the client's company, there is a clear problem. Why? Because the auditor may want the company to perform well financially and might ignore audit issues just to protect the value of their investment. So this creates a self-interest threat. When evaluating this threat, two key things matters: who owns a financial interest and whether the financial interest is direct or indirect. Now, certainly people are strictly not allowed to hold any direct or material indirect financial interest in the audit client. Uh, the, um, the audit firm or network firm and any audit member of their immediate family and any partner in the same office as the engagement partner and any partner involving non-audit services. So basically anyone closely connected to the audit must stay completely independent. Now what about immediate family members? They can sometimes hold financial interest like pension investments or share options, but uh, and this is important, they must dispose of them as soon as possible once they have the legal right to do so. Next, if financial interests are received indirectly, like through inheritance or as a gift, they must be disposed of immediately. Now, let's talk about close family members. Sorry. So, we were talking about close family members. If a close family member of an audit team member holds a financial interest, that team member must be removed from the audit and the work must be reviewed independently. Now, moving to the next area, loans and guarantees. Here, the threat again depends on whether the loan is from a bank or not and whether the amount is material. First rule: loans and guarantees to audit clients are not allowed unless they are immaterial to both parties. Now, if the audit client is a bank or financial institution, loans are allowed only if they're given under normal terms and conditions. If not, it's prohibited. Also, if the loan is material, even under normal terms, the audit work must be reviewed by an independent reviewer and another network firm not involved in the loan. Finally, if the audit client is not a bank, any loan or guarantee is not allowed unless it is immaterial. Sorry, just give me 1 second. Now, let's look at another situation. Okay. uh, um, Involving loans. So, an audit team member working on the audit of a bank is offered a loan at a preferential rate due to the involvement with the audit. So, basically, the loan is being offered because of the role in the audit, which is a problem. The loan must be declined as it would not be covered under commercial terms and conditions available to everyone, therefore, could affect the judgment of the auditor. So, since this is not a standard offer available to everyone, it creates bias and must be rejected. Now, let's look at overdue fees. A self-interest set may be created if client are may be created if fees payable by an audit client are overdue during the audit engagement. So, if the client hasn't paid yet, it can affect the auditor's independence. The firm is expected to obtain payment before the auditor's report is issued. This is to reduce any pressure or bias. The firm may treat the client favorably to ensure the fees are paid. Factors to consider include the value of the debt, how long it has been outstanding, and the client's ability and willingness to pay. There is a risk that the auditor might go easy on the client, so basically, we assess how serious the situation is. To manage this threat, we obtain partial or full payment of the fees, um, or have an appropriate reviewer who did not take part in the audit to review the work. This adds an independent check. If fees remain overdue for a long time, the firm should consider whether they effectively become a loan and whether to continue engagement. So at this point, independence is seriously at risk. So that's why we use the safeguard. Now let's look at business relationships. If audit firms or members enter into business relationship with clients, such as joint ventures or marketing arrangement, this creates a self-interest threat. A firm or audit team member should not have a close business relationship with an audit client unless it is immaterial or insignificant. So, the auditor has a direct interest in the client's success, and only very small and insignificant relationships are allowed. The factors to consider include whether the transaction is in the normal course of the business and is immaterial. So, again, we check how usual and how significant it is. The purchase of goods or services from a client does not usually create a threat if it is in the normal course of the business and on commercial terms. So, normally, fair transactions are generally acceptable. So, overall, the idea is to avoid any financial or business connection that could affect independence. Now, let's continue with purchase and employment situations. If the purchase of goods and services by an audit team member represent a material amount, that person should be removed from the audit team or the transactions can should be reduced. So if the amount is significant, it can affect independence. So either the person is removed or the transactions are reduced. Now let's look at potential employment within audit client. If a member of the engagement team expects to become an employee of the client, they may avoid actions that could affect their chances of getting the job. So basically, the judgment may become biased or because of future personal interest. The firm must have policies requiring individual to notify the firm if such situations arises. The firm needs to be informed as soon as possible. When this happens, safeguards are applied, which are remove the individual from the engagement or have an appropriate reviewer review any significant judgments made by that individual. The auditor, uh, this is about contingent fees now. The auditor may be influenced to achieve a particular outcome if the audit fee depends on that outcome. For example, they might ignore adjustment to show higher profit, which is for fees based on outcomes such as profit levels are not permitted for audit engagement. So the audit fees must never depend on results. Contingent fees are also not allowed for non-assurance engagements if the fee is material to the firm or depends on a future audit judgment involving a material amount. So again, if it affects independence, it is not allowed. Let's look at an example. The finance director suggests that the audit fee should be based on the company's profit before tax. Now, here the fee depends on performance. The audit firm must refuse and explain that the audit fee should be based on time spent and the skill and experience of the audit team. So, overall, audit fees should always be objective and not linked to outcomes. Now, let's talk about compensation and evaluation policies. A self interest threat is created when a member of the audit team is being evaluated on or compensated for selling non assurance services to that audit client. Basically, if someone earns more by selling extra services, their independence can be affected. The significance of the threat depends on the proportion of compensation linked to such services, the role of the individual, and whether promotions depend on these sales. So we assess how much influence this has actually on the person. Now, for the audit team members, the firm should revise the compensation or evaluation process, remove the audit team member from the client, remove the audit team, remove the individual from the audit team, or have an independent reviewer review the work. So, either the incentive is removed, or the person is removed, or their work is checked. Now, let's talk about the key audit partners. A key audit partner must not be evaluated or compensated based on their success in selling non assurance services to the audit client. For senior roles, the rules are stricter. This is completely not allowed. And yeah, so let's look at actual or threatened litigations. Litigation can indicate a breakdown of trust between the auditor and the client. So, if there's a legal dispute, the relationship is already damaged. This may affect the auditor's impartiality and reduce the willingness of management to share information. So, both independence and audit quality can be affected. The significance of the threat depend on the materiality of the litigation and whether it relates to a previous audit. So, we check how serious and relevant the issue is. To manage the threat, the auditor can discuss the matter with the client, or if it involves a specific individual, that person should be removed from the engagement or have an appropriate reviewer review the work performed. Okay, now let's talk about familiarity threats. When an auditor becomes too sympathetic or too trusting of a client and loses professional skepticism, or where the relationship goes beyond professional boundaries. Basically, the auditor becomes too comfortable with the client, which reduces objectivity. Let's talk about the long association of senior personnel. Using the same senior personnel of an engagement for a long period may cause the auditor to become too trusting, leading to material misstatements going undetected. So, over time, familiarity reduces skepticism. A self individual threat may also arise if the individual is concerned about losing a long. Oh, sorry. Sorry. A threat may also arrive if the individual is concerned about losing a long-standing audit client. So, personal attachment to the client can also affect judgment. Now, in evaluating this threat in relation to the individual, the firm should consider the length and closeness of the relationship, uh, the time spent on the audit, level of supervision, influence over audit outcomes, and the interaction with the audit client. So, basically, how deeply involved and influential that person is. In relation to the audit client, uh, yeah, the firm should consider whether the complexity of the work has changed and whether management has changed and whether there have been structural changes in the organization. So, if the things are changing, the risk may also change. Now, let's look at the safeguards. Yeah, so we were talking about safeguards, so which are rotate individuals of the audit team, change the role or responsibilities of the individual, or have an independent reviewer review the work, or perform regular internal or external quality checks. So the engagement is monitored constantly and external perspective is added. Now, for listed clients, the key audit partner must not serve for more than 7 cumulative years. So, there is a fixed time limit to prevent over familiarity. After this period, they must be rotated off to maintain independence. Now, about cooling off periods. The cooling off periods are 5 years for for engagement partner, 3 for the EQR, and 2 for the key audit partners. So, after serving the maximum time, they must stay away for these specific periods. During the cooling off period, the individual must not be part of the engagement team, consult with the team or client, or provide services to the client, or take any role involving significant interaction with management. So basically, they should have no involvement in all and at all with the client during this period. In exceptional circumstances, a key audit partner may be allowed a 1 year extension if necessary to maintain audit quality. So, in only in rare cases and only for one extra year, can the key audit partner may be allowed to maintain its seat. If an audit client becomes a public interest entity, the time already served as a key audit partner is still counted. The previous year are not ignored if a company becomes public. If the partner on the audit at another firm, that time is also included. So, total experience with that client matters not just within one firm. An independent regulatory body may allow an exemption from rotation if the firm does not have inexperienced personnel. So, in rare situations, flexibility is allowed. Now, let's understand with an example. Oh, actually, no. This is very easy and you can just read it on your own. I'm going to move forward. Now, let's look at family and personal relationships. A familiarity threat and sometimes self interest or intimidation threat may arise when an audit team member has a relationship with someone at the client who can influence the financial statements. So basically, if someone close to the auditor has power in the client company, independence can be affected. Factors to consider include the individual's role in the audit, the role of the related person at the client, and how close the relationship is. So we assess both sides of the relationships and its impact. Now, for audit team members, if an immediate family member is a director or in a position to influence financial statements, the auditor must be removed from the engagement team. So, in serious cases, removal is mandatory. If an immediate member or close family member has influence, safeguards include removing the individual or ensuring they do not deal with related matters. Either remove them completely or limit their involvement. Now, for other employees and partners, the firm must have policies for situations where a partner or an employee has a relationship with someone at the client, even if they're not part of the audit team. So the audit risk is considered even beyond the audit team. The firm should have exist responsibilities and have an independent reviewer review the work. So again, reduce influence and add a check. Now let's look at recruitment services. Threats may arise if the firm is involved in recruiting senior personnel for the client. So here the firm may become too closely involved with the client's management. The firm may also be seen as taking on management responsibilities, which is not allowed, obviously. However, reviewing qualifications and interviewing candidates to assess financial competence is allowed, with limited involvement is okay. Recruitment services can be provided only if the client can make all decisions, including selecting the candidate and deciding terms. So the firm can assist but cannot take decisions. So overall relationship and involvement with the client personnel must always be controlled to maintain independence. The firm cannot provide recruitment services for directors or senior management who are in a position to exert significant influence over the financial statements. So basically, for high level positions, the firm cannot be involved at all. Now let's look at audit employment with an audit client. A self interest threat, a familiarity, or intimidation threat may arise when a partner or an employee of the firm joins the audit client in a position of influence. So, here the risk becomes from the in connection between the firm and the individual. The firm must ensure that no significant connection remains, such as entitlement to benefits or involvement in the firm's activities. So, once the person leaves, all ties should be completely cut. The firm should consider the position taken by the individual, their involvement with the audit team, and the time since they left and the previous role. So, we assess how strong the connection still is. Now, for former partners of our audit team members, safeguards include modifying the audit plan, assigning experienced team members, and having an independent reviewer review the work. So the audit is existed to manage the risk. For listed clients, if a partner joins a listed client in a position of influence, independence is compromised unless audited financial statements covering at least 12 months have been issued before the partner left. There must be a gap before they can take that role without affecting independence. The partner must also not have been part of the audit team during that period, so they should not have involvement in the audit cycle. If a senior or managing partner joins a listed client, independence is compromised unless 12 months have passed since they have held that position. So, again, a cooling off period applies. So, overall, when firm members join, client strict rules are applied to ensure independence is not affected. Okay, so for this video, I'm going to stop here. From the next video, I'm going to be talking about self-review threads. If you found this video helpful or useful, please share it with your friends. And thank you for watching.